Hello, everyone. Good morning, good afternoon, good evening. Welcome to our webinar on the IMF's new Global Financial Stability Report, which we know as GFSR, the chapter on climate change, physical risk, and equity prices. I'm Sonia Gibbs, Managing Director and Head of Sustainable Finance at the IIF, and thank you for joining us today. Just a few logistical notes before we start. I want to remind you that this discussion is on the record and that members of the press are in attendance. If you've got questions, please use the Q&A prompt at the bottom of your screen. We'll try to get to as many as we can. And note that if you're joining by phone, you can only listen and won't be able to submit questions. So we want to get moving quickly. We've got a lot to cover. And so let me introduce at this point Tobias Adrian, who is Financial Counselor and Director, Monetary and Capital Markets Department at the International Monetary Fund. And he's going to offer some opening remarks. Tobias, please.
Thank you very much for this invitation to launch our chapter on climate change, physical risk, and equity prices for the Global Financial Stability Report at the Institute for International Finance. Let me mention that the chapter and the related blog have been posted on the IMF website this morning. Understanding the implications of climate change for the global economy and the global financial system has become a central theme for the IMF over the past few years. You may recall Chapter 6 of our GFSR last October, which discussed the rise of sustainable finance. In the recent issue of the GFSR, we focus on physical risk related to climate change and how it could affect financial stability. Climate scientists have been warning that climate change will increase the frequency and severity of many climatic hazards. This implies that economies and financial systems will likely be subject to greater climatic shocks. The COVID-19 crisis has shown how fast and extensive disruption of economic activity can be, even for well-known types of risks, underscoring the importance of preparedness and adequate risk management. In this GFSR chapter, we both draw lessons from the past and try to gauge investor attention to future physical risk. We do so by focusing on one asset class, equities. A key lesson from analyzing the past on equity markets and financial sector equities is that country characteristics matter, especially for tail events. Countries with more fiscal space are able to deploy a swift response to the disaster in the form of financial relief and reconstruction efforts, which limits the impact on domestic equity prices. Also, well-developed risk-sharing mechanisms such as insurance reduce and redistribute the disaster's losses and help limit the adverse impact on equities. Looking forward, the chapter analyzes 2019 equity valuations across countries and finds that they did not reflect any of the commonly discussed global warming scenarios and associated projected changes in hazard occurrence and incidence of physical risk. This apparent lack of attention by investors could be a significant source of market risk looking forward. What does that imply for financial sector institutions and for policymakers in charge of financial stability? First, I believe it is important to strengthen climate literacy by enhancing the visibility of relevant findings in climate science, climate economics, and climate finance. I want to thank again the IIF for giving us the opportunity to do so through this event today. Second, we need to fill data gaps. Better granular, firm-specific information on current and future exposures and vulnerabilities to climate shocks would help lenders, insurers, and investors to better grasp climate change risk. Developing global mandatory climate change disclosure standards would be an important step to help enhance climate change risk pricing and preserve financial stability down the road. Third, we need to step up climate change stress testing and scenario analysis more generally as essential tools for climate change risk management. This will yield benefits for both financial sector supervision and for financial firms. The IMF has pioneered the use of stress tests for financial stability some 20 years ago in the Financial Sector Assessment Program, or FSUP. a joint program with the World Bank. Over the past decade, 1 in 5 FSAPs contained an examination of climate change-related physical risks. We are planning to do more going forward. Let me conclude by saying that these recommendations apply, of course, not only to physical risk, but also to climate change-related transition risk. This GFSR chapter is fully focused on physical risk, but we're working on a chapter for the fall that is looking at transition risks. I'm looking forward to an exciting panel discussion. Let me now turn to my colleagues for the presentation.
Thank you very much, Tobias, for setting the stage, and certainly very topical with the growing focus on climate stress testing, getting ready for that. And I'm now pleased to welcome 2 experts from the IMF Monetary and Capital Markets Department who are leading the work on climate change risk. And we have Jérôme van den Busch, who is Deputy Division Chief, and Felix Sondheim, who's financial sector expert. So welcome, Felix and Jérôme, and please help make us all more climate literate, as Tobias says.
Thank you very much, Tobias, and thank you very much, Sonia, for the opportunity to present our work on climate change, physical risk, and equity prices in this webinar at the IMF. So in the chapter, we analyze the link between physical risk and financial stability. The starting point is pretty straightforward. Climate scientists are predicting with an increasingly high degree of confidence that future global warming will imply greater frequency and severity of climate hazards. These hazards are a source of physical risk because they cause damage to property and disruptions to economic activity, which in turn can adversely affect asset values. As Tobias mentioned, the chapter focuses on one asset class only, namely equities. We focus on a sample of 68 countries, which represent 95% of world GDP, and we observe them during the period 1970 to 2018. The chapter first looks backwards at past disasters and then looks forwards at future disasters. Let me explain why in the next slide. So this slide explains the 2 main channels through which physical risk impacts financial stability. First channel is shown on the left-hand side of the chart. When climate hazard hits a region with a high level of exposure and vulnerability, it turns into a disaster, a climatic disaster, which then in turn adversely affects households, firms, and governments. The shock to these 3 sectors is transmitted to the financial sector through the realization of underwriting risk, credit risk, and market risk. Note that climatic disasters can also affect financial institutions directly through operational risk and liquidity risk. The second channel is shown on the right-hand side of the chart. It's a repricing risk channel that operates through shifts in investors' attention to and expectations of future climatic disasters. A mispricing of future climate change physical risk could have an abrupt and adverse impact on financial institutions' balance sheets when it is corrected. In the next 4 slides, I will go over the first channel. My colleague Felix will then take over and discuss the second channel. This next slide explains how we measure the equity market impact of large disasters. For each disaster, we calculate an associated cumulative abnormal return, or CAR, CAR, for a domestic stock market index. Specifically, for each disaster, we define 2 windows as the figure illustrates: an estimation window before the event and an event window surrounding the event. First, we compute the expected return based on observations during the estimation window using a single global factor model. Then, in the event window, we compute the cumulative abnormal return. That is the difference between actual return and the expected return. We compute it relative to 21 trading days before the start day of the event to incorporate any potential anticipation effects. Then we take the average over individual CARs. Before turning to our results based on CARs, let me first illustrate the large heterogeneity in equity market responses across disasters. The chart on the left shows the cumulative raw returns around two very large disasters in the sample. The red line shows the Thai stock market return around the onset of the 2011 floods in Thailand, which is the largest disaster according to economic damage to GDP in our sample. The equity market fell by 30% after the onset of the disaster before gradually recovering. The green line shows the US stock market return around the landfall of Hurricane Katrina, which resulted in the largest damage in absolute terms in the sample. Katrina triggered only a modest stock market reaction with no discernible drop in the aggregate US stock market index. The chart on the right shows the result of our analysis of the largest 350 disasters over the past 50 years in the sample countries. The cumulative average abnormal return is about -1% after 40 days. The effect is therefore statistically significant, but the magnitude is only modest. The slide documents the impact on the financial sector now. The left chart shows the negative impact of large disasters on the banking sector in advanced economies and emerging markets. You can see that the impact is negative and slightly larger than for the market as a whole. It reaches the trough of about -2% after 30 days. The chart on the right shows the impact of large disasters on the non-life insurance sector in advanced economies. As for the banking sector, we observe a significant negative impact, which reaches about -2.5% after 40 trading days. For the non-life insurance sector in emerging markets, by contrast, we do not find any significant effect. This is my final slide for this first part of the presentation, but it's perhaps the most important slide in this first half. Here, we ask whether certain country characteristics can mitigate the impact of large disasters on equity returns. We focus on two characteristics in particular, as Tobias explained earlier: non-life insurance penetration and sovereign financial strength. Non-life insurance penetration captures the degree of risk sharing offered by financial markets. Greater sovereign financial strength allows for the provision of explicit and implicit public insurance in the form of post-disaster relief. The left chart shows the mitigating effects of an increase by 1 percentage point of insurance penetration on the overall market return, on the banking sector returns, and the industrial sector returns. We look at both the average returns in green and on the left tail, the 10th percentile in red of the return distribution. The left tail corresponds to events associated with very poor stock market performance. You can see that the mitigating effect is up to 1.5% for the average and up to 4% for the left tail. Similarly, the right chart shows the mitigating effects of a one-notch upgrade in the sovereign rating. We find that the mitigating effect is up to 0.4%. And again, we find that the effects on the left tail are much larger. These results from the backward-looking analysis are important because they show that no matter what the size of future climatic disasters, and no matter what the size of future climate shocks, greater sovereign financial strength and greater insurance penetration will help preserve financial stability. Let me now pass the mic to Felix for the second half of the presentation.
Thank you, Jerome. So to summarize, large weather disasters have had a significant adverse effect on aggregate equity prices, but the average market reaction was relatively modest. However, as you can see in the two charts on this slide, because climate change is expected to lead to an increase in the frequency of extreme weather events, the past in this case may be a poor guide to the future. We can see here that over the course of this century, the likelihood of events such as the number of dangerous heat days, The number of days with extreme precipitations, heat waves, and droughts is expected to increase dramatically. Also, the figure doesn't only show the median projections across a number of climate models, it also shows the range of the projections. So you can see the large variation and hence the enormous amount of uncertainty that investors face. But investors not only need to form views on these various climate scenarios and their implications for physical risk, they also need to understand the future location of production sites, of firm supply chains, and the distribution of customers. So overall, this represents a very difficult challenge, in particular given the scarcity of firm disclosures. It's therefore hardly surprising that there is very little empirical evidence on whether the valuation of equities today reflects future physical risk. And that's exactly the question that we are going to address now. We do that using three analytical approaches. First, in a very simple cross-country econometric analysis, we determine whether current equity valuations are sensitive to current proxies for future changes in physical risk. Then, second, we focus the analysis on investor attention to temperature, which is an easily observable climate variable. And finally, in an alternative but slightly more complicated approach, we develop an asset pricing model that takes into account the projected impact of climate change. What I will show you now are the results from the first two approaches, but a stylized version of the pricing model is included in online box 2 of the chapter, and the findings are consistent with those from the other two approaches. So let's turn to the cross-country econometric analysis. Here, we test whether current aggregate equity valuations are sensitive to current proxies for future changes in physical risk. And I'll show you these two pieces of evidence here that they are not. First, on the left, in a simple scatter plot, we show the price-earnings ratio, so a standard valuation measure, together with the composite climate change hazard index. This index roughly measures the degree to which economies are exposed to current and future climate extremes. And as you can see, there is hardly any relationship between the two for both advanced economies and emerging market economies. Then, in the right panel, we turn to a more sophisticated model. The table shows the signs of the coefficients from regressions of, again, the price-earnings ratio on different climate change physical risk indicators. However, this time we're also controlling for fundamental pricing factors. The climate change risk indicators that we use, you can see them here in the table, are again the projections that I showed earlier. So change in extreme heat exposure, extreme precipitation, drought likelihood, and heat wave likelihood. And then we include two more measures, an index of projected sea level rise, and again, the composite climate change hazard index, that's the one we used in the scatter plot on the left. We then run this analysis for 4 different climate scenarios, RCP 2.6 to RCP 8.5. If climate risks were priced, we would expect a negative and a significant sign here. So everything else equal, equity valuations in countries with high levels of climate risk should be lower than those in countries with low levels of climate risk. And as you can see, that's not the case. The relationship is either positive, or in the case of the projected change of the drought likelihood, that's the row in green, the sign is negative but non-significant. So overall, we do not find evidence which would suggest that equity valuations are negatively associated with projected changes in hazard occurrence. The results are robust to a large number of additional tests using proxies for climate change physical risk and different measures of equity valuations. We also include different control variables and interaction terms. Then the second, more indirect test focused on temperature. Temperature is a climate variable that is readily observable. It's available at high frequency, and it does not suffer from the same measurement challenges as other climate change variables. We use it to construct a temperature sensitivity measure, which basically captures how firm stock returns co-move with temperature extremes. What we want to test is if after controlling for standard equity pricing factors, a portfolio of firms with a high sensitivity to temperature is mispriced. This would then imply that there is a pricing anomaly related to temperature. And then, indeed, as you can see in this figure, we find that in 10 of the sample economies, a portfolio composed of such stocks, so stocks that are most sensitive to temperature, underperformed by at least 0.5% a month. So these are the solid bars here on the left, which show that the markets with significant mispricing. Again, this suggests that equity investors have not paid enough attention to climate variables, which in turn suggests that they may not be paying sufficient attention to climate change risk either, and that would reinforce our earlier findings. So let me conclude. Pricing the impact of future climatic hazards is a challenging task because it requires an understanding of both the future behavior of climatic and non-climatic variables, both subject to a large degree of uncertainty. The chapter documents that in the past, the reaction of equity prices to large climatic disasters has been modest. But the analysis also suggests that equity valuations today do not reflect future climate change physical risk. We also find that country characteristics matter. In particular, insurance penetration and sovereign financial strength can lessen the impact of climatic disasters on equity prices. Policy recommendations. First, these findings imply that regardless of the magnitude of future climatic hazards, expanding the availability of a non-life insurance and improving sovereigns' financial strength would be beneficial for financial stability. Second, developing global mandatory disclosure standards on material climate change risks would be desirable. In particular, granular, firm-specific information on current and future exposures would help with the pricing of climate change-related physical risk. And third, for financial firms, climate change stress testing can play an important role as well. Of course, although not explicitly analyzed in our chapter, adaptation and risk reduction measures that decrease or at least limit the exposure and vulnerabilities of economies to climatic hazards are highly desirable as well. So with this, let me finish here and hand over to Sonia for the panel discussion.
Thank you very much, Felix. Thank you for an excellent presentation. Certainly your points on the climate risk disclosure will really resonate with this audience. Very hard to assess the physical risks or get a good framework for stress testing without more international harmonization around ESG disclosures. So points very well taken. Before we start the panel discussion, we do have a couple of specific questions for you and Jérôme, if you don't mind, very quickly. One is, Felix, your models suggest mispricing. Could you comment on some of the potential reasons for this, which could include, for example, simply short-termism and the fact that equity markets are highly liquid, and what kind of tools you have for looking at financial stability risks from such factors, including herding and other transmission channels?
Right. So we didn't look into that in more detail, but it's an interesting question. Of course, it will depend on investors' ability to use relevant information and to properly assess relevant information. So that's again an angle with related to disclosure, and then it might depend on investors' actual attention to climate risk. It could also be related to investors' horizons. So we see for some countries less mispricing than for others. So it could be that some investors are more long horizon than others. But we didn't look at that in more detail. But it would be an interesting analysis.
Yeah, we're happy to provide material for your next chapter. Okay, so why don't we go ahead and turn to our panel discussion here, and let me welcome at this point Jan Loijs, who is Managing Director and Senior Advisor for Strategic Research at JP Morgan. So now we'll go ahead and kick off our panel discussion, but Jan, let me turn to you first. You and your colleagues at JP Morgan have put together some really interesting research on ESG, looking across sectors and asset classes, and how you look at ESG opportunities and risks. So what's your take on the IMF presentation?
Well, as you say, I advise our investors on strategic longer term. And the big risk out there is obviously, in my mind, climate. So this study is really fascinating. I've learned a lot. Indeed, I've learned that the equity market is so far ignoring it. And I'm a bit worried about that also, that it is not in the price. But the information, the data that Felix and Jerome have given us, are basically also giving me the answer as to why the market is ignoring this. It is that, yes, temperatures have been rising. The frequency of disasters, climatic damage has increased. But the amount of damage that we have there has actually not increased relative to world GDP. We're talking about pretty much the last 20, 30 years, 15 basis points of world GDP. World bond and equity markets, it's the same thing, world corporate debt and equities. So if all this damage were to incur by listed companies, we're talking about an annual damage of 15 basis points as an investor. Now, a lot of these damages will be incurred by non-listed companies, households, and governments. Say that these corporates incur about a third of this, we're talking 5 basis points. That's nothing. That's puny relative to the massive volatility in earnings, corporate defaults, and such. The market is looking at facts. Yes, we know all the warnings. We respect the scientists. But the evidence on the ground is that this is a rounding error. So given what investors have to deal with, you can't really blame them for ignoring something that really hasn't happened yet. It's all about forecast. And I clearly don't want to sound like a denier over here, but that is one of the fascinating things that I got from this study. So how does an investor look now? The largest investors are completely convinced that, yes, this is a very serious risk for the future. They're looking at both the risk of where can they lose money due to climate events, and where the opportunities, where the returns, how can you ride the efforts, the regulations, the movement towards a decarbonization of the world. On the risk side, it's been tough because the damage has not really been that high. And they're largely focused on emerging markets, as the IMF study is showing, are more vulnerable. So dump that one. At insurance companies, you're arguing that insurance penetration would reduce the vulnerability of these economies. Yeah, but you then give it all to the insurance companies and you hope that they manage it well. And all the evidence so far I can see on the catastrophe models and such is that these models cannot look very far. They look 1 year out and push the insurance companies to cover more of this. The regulators basically want cheap insurance and they want insurance available. And as a result, we're pushing more and more people to be insured in areas where they shouldn't be living, like in flood areas. That creates a massive moral hazard. I'm not really that into getting insurance companies there, but investors are clearly saying this is dangerous there. The opportunities is, can we ride carbon pricing? No, haven't really done that much yet. Can we ride the renewable energy world? The new technologies are going to help us mitigate and adapt to this new world. Until this year, that has been a huge money loser. The renewable energy world has actually lost a lot of money. In addition, the problem is that the ESG and the climate investor, sustainable investor, is too small. Another chart that was not shown in the PowerPoint that is fascinating from Felix and Jerome is that so far, sustainable equity investing is about 2% of world outstandings. That has one big impact. If you as a sustainable investor are really trying to get to punish, so to speak, the high carbon world, the one that's not really helping us, and to benefit the lower carbon world, the new technologies, you're doing that by pushing up the cost of funding of high carbon and lower that for low carbon. The problem is the other 98% of the equity market that is not following your sustainable investing are value oriented. So you make the coal producer, the coal mines have a higher cost of debt. The value investor will immediately arbitrage that. So it's not really working. The one thing, my last comment, is that the large investor has learned that is having an impact is not ESG investing. it is ESG and climate activism. The moment that you are standing up at a shareholder meeting and you threaten not to vote to reinstate management and board members, they're paying attention. So I'd say look at the large investors are moving towards activism rather than ESG investing in order to help change the world. Thank you, Sonia.
Thank you, Jan. And it's a very interesting point you made about only 2% of equities falling into a sustainable bucket. It really highlights some of the interesting differences in definitions and terminology. You know, what do you call sustainable or responsible investing? It's defined very differently in different quarters. So some say up to a quarter or a third of global equities are sustainable. So, you know, what's in a name? So, interesting point. We've had a couple of questions in. We've got a big queue of questions. So, and two of these pertain to pricing. And so perhaps for you and Jérôme together, do you see differences in equity valuations in companies that have activist investors? You know, Jan, you were just talking about activist investors who are focused on the green agenda. So, you know, are they more accurately priced because they have activists pushing behind them? And what about companies with better disclosure? Are they more correctly priced?
I have not done studies on that, but the principle ought to be that investors that disclose more and that are trusted, are honest. I think the prior ought to be, and I think I remember seeing something on that, they get priced better. I mean, they are trading at higher multiples and at lower cost of debt. Where activism helps, not sure. I don't have not seen it. It may create some disturbance. It may force, at least from a pure shareholder profit maximizing point of view, they may be wary that it is forcing the company to pay attention to other things rather than maintain the dividend. So my prior would probably be that it's not that great for the stock price, but I have not seen the evidence.
Jérôme, did you look at these in your studies, these factors?
So we would have loved to look at this. You know, one issue is that we do not have firm level exposure to physical risk. So that's why we did a study at the country level, and we would not be in a position to say anything about individual firms valuation and how this valuation might not correlate with some of their attributes. The simple reason again is a data issue. We don't have firm level physical risk exposure measures.
So, on a related note, a question here for Tobias, and this is really in the realm of policymaking. So, the IMF is taking an increasing role in looking at climate risk, and these are becoming part of stress testing conducted by the IMF and FSAPs and all that. Are you going to be publishing reports on these risks, and how are you going to be working with the Network for Greening the Financial System and the traditional standard setters on kind of creating a harmonized international framework for these?
Yeah, thanks so much for raising the policy issue, and just to frame the issue within this discussion, which has been very rich already. So clearly we see that when we look across countries, those countries that are expected to be more exposed in the long term to climate disasters don't have systematically different pricing from countries that are less exposed to climate disasters in the future. So far into the future, potentially very large downside risks are today not priced into the market. So the cost of capital, the market cost of capital doesn't differentiate along this climate dimension. And I think Jan explained that there are very good reasons for why, from an investor's point of view, there shouldn't be differentiation at this point in time. But of course, from a policy point of view, we do worry about these very potentially very large, very disastrous downside risks. And so the policy motivation is to build a framework that is going to allow investors, but also regulators and firms to take decisions that are taking these climate risks into account. So what we're doing here at the IMF are three things. So number one, we are starting to very systematically conduct climate stress testing within our financial sector assessment programs. In the past, we have done this in some of our assessments, in particular for countries that are currently exposed to climate disasters, such as Caribbean islands that are regularly hit by hurricanes. Secondly, we're looking more and more at transition risk as well. So that is the risk that countries are facing as the economy is moving towards a less carbon intensive economic model. And then thirdly, we are also looking at these longer term questions in the stress test. So this is climate stress testing. Second, we are working together with the standard setters, together with the industry, but also with accounting boards, accounting and setting boards, to work on a disclosure framework for climate exposures, so that investors and firms and households, as well as policymakers, can do an accurate assessment of how much climate risk exposure firms are having, and as the situation is evolving over coming years and decades, there is a better and better ability to assess these climate risks. And then thirdly, we are going to continue to do the kind of studies that you saw today, which are more global assessments of where we are with respect to climate risk and you know, the financial stability implications, but also broader macroeconomic implications of these climate issues.
Thank you. And that actually is a good fit with a related question that's come through here about the kind of caliber of the current toolkit that we have. You know, you've done quite a lot of work now on assessing these risks, and it's such a multidisciplinary field with a complex toolkit. How much do policymakers and investors, how good is this toolkit at this point? Do they have the right tools? You know, on a scale of 1 to 10, you know, where 10 is the perfect toolkit, and you know, where are we now?
Let me jump in here. So I think we're just at the beginning of this journey. So there's quite a bit of momentum in the policy sphere internationally to really improve the policy toolkit that is out there. As you mentioned, we are members of the Network for Greening the Financial System. That's an initiative by central banks. I think by now it's over 60 central banks globally, which are looking at the kind of tools that central banks are having in order to improve the toolkit for policymakers. So this includes stress testing, but also supervisory and regulatory approaches around climate issues. And then, of course, the disclosure that has been mentioned, and broader issues around central bank policies.
So a quick follow on there. Does that not imply that stress testing should be very carefully thought through and perhaps implemented at a later stage when the toolkit is better developed?
So the IMF has conducted stress tests for 20 years. And of course, over 20 years, there has been a tremendous evolution of the stress test technology, as well as of the usage of the stress test. So it's really only after the 2008 crisis. So once the IMF had done 10 years of stress testing for financial institutions, that pretty much every jurisdiction around the world adopted the stress testing as a first order supervisory tool to make sure that institutions were adequately capitalized. So it might well be that for some time we're going to do climate stress testing, and it's only going to be in the future that this is going to be a first order tool for regulators. Now, having said that, there are many central banks and many regulators around the world that are already very actively engaged in this agenda to do climate stress testing and to make sure that financial institutions are prepared to both transition risks and physical risks.
Okay, so I've got a one policy question for you and Jérôme, and then a market question for Jan. This comes in from, in fact, one of the members of the Network for Greening the Financial System. You mentioned that sovereign financial strength and more insurance penetration will help mitigate climate change physical risks. But how do you increase insurance penetration in a context where premiums may increase for affected firms and many of them may not be considered to be insurable? So I guess from a policy perspective, how do you go about increasing insurance penetration?
Yeah, so I would say that financial literacy is a key component here. So making households and firms aware of the possibility to buy insurance against climate risks is something that would certainly be helpful in some countries. So in countries that are hit frequently already today with climate disasters, such as Caribbean islands, you do see that financial institutions tend to be very well insured, but households and small and medium-sized businesses still have a very, very low insurance penetration. And so their financial literacy can make a big difference. I mean, just to explain to people that the risk of being hit by another hurricane is very high, and there's an insurance market, and that can help you overcome these tremendous hardships that are implied by disasters.
And I guess more broadly, what role does the IMF play in providing technical assistance for governments and public agencies, especially in emerging markets, on understanding climate risks and assessing them more?
So we're helping on a number of dimensions. So we are going to help our membership to develop climate stress tests. As I said earlier, some advanced economies have quite sophisticated climate stress testing tools, and we can help countries that are not yet at that level to develop those tools. Secondly, globally, we're developing, together with institutions such as IIF, but also accounting centers and other important players in the financial industry, disclosure standards to make sure that investors can understand what type of climate risk exposures different companies have. And then thirdly, we are working also on the supervisory and regulatory approaches that are being really developed under the leadership of the NGFS at the moment. And the IMF is an institution that helps to spread new standards and new techniques, new approaches around the world across our very broad membership.
Jan, let me turn to you here. Here's one for you. On the kind of emerging and developing economies, we've talked about emerging markets being more exposed to climate risk. And so is this differential approach appropriately priced? Is this factored into prices on emerging market assets? And a related question, do we need more investment opportunities around the SDGs, so more SDG funds pertaining to the Sustainable Development Goals? And what's your thoughts there?
Well, is it priced in? Very hard to say. Obviously, we only have one price. We have a yield gap or a borrowing spread for emerging versus the and we have multiple factors that are driving that risk premium, because it is a risk premium in emerging markets. So unfortunately, I have one price. I have 10 potential explanations. I can't really go from the price and say, right, here's what is priced in on extra climate risk in emerging markets. Yes, emerging markets have a higher cost of equity funding and of debt funding. That's been around for some time. It's been relatively stationary. 10, 20, 30 years, we're talking about the same kind of multiple differences. The main driver of emerging risk premium versus the developed is governance. The World Bank, Worldwide Governance indicators that the best explanation of differences across countries in risk premium It's also a good explanation for GDP per capita. So your broad issues of governance of your countries, how well you govern, the rule of law, transparency of regulation, all of them explain that. I haven't seen that much changes in them. So I can't really say at the moment whether emerging markets is priced in rightly or not. Broadly, investors have been, in the equity world, been getting out of emerging markets for the past decade. I think most of this is to do with the peak globalization, the threat of deglobalization that is out there, and that's been hurting labor productivity of emerging market. Productivity growth in emerging ex-India, China, where we have data problems, have been coming down to about the same level as the developed world. So your convergence is finished. And as a result, investors are pulling back. Until we see emerging markets actually pulling themselves up, their own socks up, and getting productivity growth up, it's hard to see much upside for EM equities. Will new products help? I think there's an abundance of products out there, and quite a few of different type of ESG indices are all a bit different. I'd say what can help the most is cheaper products. A lot of these ESG products come with very heavy duty fees. They're great for the manager, not necessarily great for the investor. So simpler products, index products in the ESG world with transparent indicators where we all agree on what is actually green, what is sustainable. I mean, I think the European efforts at getting a clean nomenclature over there are really beneficial in that. So simpler products, cheaper products is what we need.
Jerome or Tobias, did you want to address that question? In your work in valuation and climate risk, did you notice more of a differential for emerging markets?
No, I think Felix put up a chart that showed that there really isn't much of a differential when you look at these forward-looking indicators of climate risk exposures, right? So valuations today don't incorporate the degree to which countries are exposed to disastrous risks in, say, 10, 20, 30, or 50 years into the future. And that is a stylized fact as of now. Of course, the current countries that are today exposed to climate risks, such as hurricanes or flooding, that does tend to be priced in to some degree, but because the physical damage relative to the global market is relatively small, those risk premia tend to be relatively small.
So another question here, has there been work done, or have you looked at the question of how much investment, say in trillions, is needed to get to a 1.5 degree or 2 degrees Celsius path? And, you know, is there a sense that, you know, private investment will be largely insufficient to get there? Other ideas for raising this kind of funding, SDRs, for example, is mentioned.
Very hard question on this. We know there is clearly a community of companies, innovators, inventors, trying to come up with new ideas for renewable, lower carbon energy. Obviously, it's been working very well in solar and in wind. It's so successful that these prices, the output prices, have been coming down faster than the costs. And as a result, these companies are not exactly very profitable. So we need a lot more into batteries and into storage. I'd say that the world is investing a lot at the moment. We need to do faster. But you can see why the investor, the private sector, is a bit wary, because the returns are not exactly there yet. We're hoping for the new killer technology that is immediately going to bring us cheap renewable energy, maybe in fusion or something. The opportunities are probably most in nuclear, but there's a lot of part of the world that is saying, wait a minute, that gives us other problems. I'd say it's nuclear energy probably where it's the most upside if we can get around the aversion of the world to.
Yeah, I just wanted to come back to two earlier points. One is the point on materiality that Jan raised in his initial remarks, and the second point is on emerging markets. So on the materiality, I have to confess that when we first look at the data, we were also a little bit surprised by the relatively low number, when we compute aggregate annual damages relative to world GDP every year. But as we mentioned in the report, there are two important things to keep in mind. One is about the level, and the other one is about the trend. So about the level, these damage numbers, you have to bear in mind that these just measure damages to physical infrastructure or facilities. Yeah, it's physical damage. So it does not capture the economic disruptions that are associated with the disaster. Does not capture either the local disruptions or disruptions through supply chains. And actually, I think that's an important area for further research. This is an area where there's also some kind of data gap here, because what really matters is not is the total economic cost, including the economic disruption. So anecdotically, I mean, for the 2018 California wildfires, there were some estimates in the press that were estimating the total financial cost of these fires to around 300 to 400 billion US dollars. That's one order of magnitude larger than the physical damage that is in our database. So I would say that the damage numbers that we talk about are just a lower bound on the total economic cost, and the total economic cost can be up to one order of magnitude larger than the damage. The second point is about the trend. So there's something that we learned through this working on this chapter, is that what climate scientists are warning us about is that the past is not a good guide for the future when it comes to climate change, right? They warn about non-linearities in climate systems and tipping points and so on, and that's where the importance of scenario analysis is really important. So yes, the damage to GDP ratio has been roughly flat over the past 20 years, but if we believe climate scientists, the trend has to move up sharply at some point. On emerging markets, I would like to refer to the last chart that Felix presented. This is where we look at the pricing anomaly across a variety of countries, and there, if you look at the chart in the report again, you'll see that the pricing anomaly is actually greater in emerging markets in the sample. All emerging markets in the sample have a pricing anomaly, but not all advanced economies. So I thought that was an interesting difference across the two country groups that I would highlight. Thank you.
Jérôme, you mentioned the magic word scenarios, and I think that's come up in a number of questions here. So one for you, and then one for Jan. What specific scenarios do you envisage running under the stress tests, and will these be kind of in coordination with those being developed, for example, by the Bank of England or the NGFS? And then Jan, I'll come to you with a kind of similar question from an investment perspective.
I think Tobias may want to answer that question.
Yeah. So we're really at the beginning of developing that, and it depends on the time horizon. So you can have scenarios over a long-term time horizon, and this is where catastrophic events might be happening. But of course, it's far into the future. And then the policy question is, to what extent should that impact behavior today? Secondly, there are the shorter term scenarios. And one shorter term scenario is physical risk that is present today. That is clearly there for some countries, but not for all countries. And then thirdly, there are the transition risks. So we expect that there will be a shift towards a less carbon intensive economy over time. For example, in the car industry, you can see that there's a massive shift from fuel burning cars into more electricity driven vehicles. And that is driven by both technological innovation as well as a shift in behavior by people as they are valuing climate sensitive products more. And that can be profitable, right? And so there's a transition in the composition of the economy. There's a sectoral change. And of course, there's some policy risk as well, because we might see that countries are moving towards taxing carbon intensity more and more going forward. So there's a kind of a policy risk exposure for certain sectors. And so this is this latter part is what we call transition risk. So as we're transitioning to a different economic structure that is preparing the world better for these big climate events and is mitigating the degree of damage and the likelihood of damage, this will change the economic fabric. And that is a risk exposure for financial institutions and for investors more broadly. So that's what is called transition risks. And so so scenarios also are not just about physical risk, which is what this chapter is about, but also about this transition.
You very cleverly answered yet another question that's come through. So, but I'll move to Jan now. It's also a scenario and assumptions related question. So how do you make the sausage here? And someone's been reading your report and they say, the report says you need to form views on the likelihood of different climate scenarios and on their implications for physical risks. That means you've got to have a pretty granular view on things like where production sites, supply chains, and so on are going to be. So how do you go about factoring scenarios and assumptions like this into your long-term strategy?
Right. As Tobias is saying, the whole issue is indeed long-term versus short-term. Some of the stress tests, I think, of the Bank of England were quite long-term. For most corporates, way too far. The furthest you can really ask an investor or a corporate to think is about 10 years. So the investor world is indeed is looking more at the opportunity than at the risk. Where can they make money? Where can they ride the movement towards a decarbonized world? And they're trying many different things. You don't have to be an ESG on a carbon fund to do that. They've tried many things. You can see at the moment there's a big move into technology. People are bidding up electric cars and such. The problem is really, it's at the moment, for most of these people, it is, yeah, we get the point, or there's going to be worsening weather events. There's probably at some point, maybe, we'll get some carbon pricing out of this, but how do we ride this? And they've tried so many things on that. So far a disappointment, because many of these sectors that are really going to be bringing us into a low carbon world are simply not making money. So only the large investors are willing to do it, and we're willing to look beyond profitability, are really doing this. I'd say there's a ton of money looking at this moment. They're putting little million here, a million there in every opportunity out there. It's really a granular one. It's not a macro one. It is not one dump insurance and be in technology. It's purely a bottom-up approach, which is why we're really looking at all of our individual sector and company analysts to figure out which one is a company that's really going to be leading this. And it's not a simple one of dump the oil companies. No, the oil companies are specialists in energy. Who's going to be, who has the best knowledge of bringing us into a new energy world? Probably oil companies. It gets to be very granular, stock picking basis.
Thank you so much, Jan. I think my big takeaway today is that we need at least 2 hours and possibly much longer to continue this discussion. So Unfortunately, this does conclude the webinar today, and thank you so much for joining us. I hope you found the discussions insightful, and our thanks to Tobias and Jerome and Felix and Jan for joining us, but most interesting presentations and discussions. So stay well,
Thank you so
have a
much.
great weekend. Thank you.